I'm going to share my complete DeGiro portfolio for 2025 with you, including some transactions in stocks and ETFs from the past few weeks, which you might also be able to use for a good start in 2025. Not only that, but first I will give a brief overview of 2024, how my wealth has actually doubled. That's great. I was financially free and now I'm a bit more financially free, so that's really nice. But money is, of course, just money. Secondly, a brief update on the evolution of my portfolio from 2024 to 2025, which is very relevant to the third point, which is how we're going to start. 2025 with a number of holdings, and my portfolio has become much more focused. It might mean a bit more risk, but it could also lead to a potentially higher return while I had a really good year. In 2024, things have been a bit less favorable, and I'll explain why. Before I show it to you, just a small request. More than 83% of you are not subscribing to our videos, and I would really appreciate it if you would subscribe. It only takes you a few seconds. Please subscribe. Why? Then our YouTube channel for happy investors and business investors will continue to grow, and the more we grow, the more it will yield, which it is already starting to do. And I will share more about that as well. And the more it yields, the more we can invest in time and also databases for the tools and analyses that we use for investing. I started investing at the age of 23, so I have over 10 years of experience in investing. And actually, I'm sharing more and more content through my companies, Happy Investors and International Business Investors. Do with it what you want, purely for inspiration, of course. And now let's take a look at the status of 2024 and then the development of my portfolio in 2025. So first, a brief overview of 2024. For me, it was quite an intense year personally, namely a major renovation behind us. What you see here in the background is a new setting. If you look at older videos, you'll see an older house, a different living room, that sort of thing. My girlfriend and I sold our home for a significant profit, just like a lot of people are doing these days. However, we bought another house, a dyke house, and we really got it below market value. And the only thing was, it needed a lot of work. At least the foundation was good, the base was strong, but we could do it ourselves, and I have almost 2 left hands. Now I don't have 2 left hands anymore. A lot done, a lot of work, and we bought the house below market value, and now it's worth even more. But one consequence of that is that we still have 100,000 in equity as cash. We took out an additional mortgage at about a 4% interest rate. Our initial mortgage was only 2.2% interest. Some have even lower. So yeah, you can still borrow relatively cheap money at 4% interest. It's not high for a mortgage loan. Not at all, when you offset that against the potential returns from stocks and other types of investments. So 100,000 in equity, that's definitely a big step in my wealth growth. And although that didn't come from stocks, this is a kind of real estate, but for your own home. There are those people who say, yeah, you should never buy real estate because in the long run, you'll end up spending more than if you were renting. Theoretically, renting is cheaper than buying. What that means is the money you have left over, you can invest in stocks. And theoretically, they might be right, but in practice, it just doesn't work that way. You might as well just buy a house because a lot of people just can't manage money very well, which is perfectly fine. Just buy a house, then at least your value keeps up well with inflation, and maybe you'll get lucky and there will be another peak. Buying below market price is already your first profit. Then regarding stocks with portfolios, has grown to about 200,000. We also have a bit of savings, so that's really good. I invested 75,000 in a small software company, a startup. So if you want to talk about risk, I can discuss that with you. And on top of that, I have a business portfolio, which has also grown to about 150,000. But it's business related, so I still have to pay dividend tax on it. So you shouldn't think of yourself as too wealthy. All in all, 2024 is looking like a good year for me. And maybe it's interesting for you too. Your little YouTube channel, which I actually didn't do much with at the beginning, is now all starting to grow. So I started a company many years ago, Happy Investors. In the meantime, I've sold half for 6 figures. There are 3 of us now. Maybe this year with more people. And what we do is help people with simple investing because there's a lot of bullshit on the internet. And especially expensive asset managers, expensive banks, they charge you while you stand there. They all use very expensive words. They use complex words. Over 10 years experience. I have a university background, all good. But listen, you can invest really well on your own. But for a lot of beginner investors, yeah, it can be complex. So a lot of people still make mistakes. And at Happy Investors, we just help with very simple investing. And because we do that, we also believe in low prices, but you can see all that on our website. Now, I would appreciate it if you could subscribe to our YouTube channel. That way, our channel will grow and we can generate more income and create more content. I'll benefit from it too, but so will you, because the quality is going to increase. Speaking of quality, just a quick note. My microphone is broken, ordered a new one. Today, the quality of this video isn't superior. But maybe more importantly, is my return for 2024. Well, that was about 30%. I'm happy with that. And the last few months, actually from the summer of 2024 until the beginning of 2025, I've mainly been reducing my positions in the USA. So I had a lot of stocks that performed well: Celestica, Sterling Infrastructure, and a few other stocks. However, I sold all of those and took more positions in European stocks. But in the last few months, those European stocks haven't performed very well. I also have an ETF for Chinese internet companies, and I'll show that in a moment, but it's not performing very well either. Still, I don't worry at all because I basically just buy good companies for the long term. And there's another strategy that I'm going to implement more and more over time, but it takes time. You have to be very patient, waiting until you can buy good companies at a good price. And the arm, and the arm, and the arm, and the arm. Having quality, and people increasingly want quality companies, just like the principles of Warren Buffett and Charlie Munger. Actually, it was Charlie Munger who came up with that a bit earlier than Warren Buffett. That also comes from others. But that aspect of quality has become very important. So for example, ASML is a high quality company. However, those valuations are only going up. So you see that those very large, strong software companies of high quality with a strong competitive advantage, which they sometimes call a moat, those kinds of companies are almost unbeatable, just in simple terms. So you're making a lot of profit, and possibly even more profit in the future. They keep paying a higher price for that. Now, a new stimulus has also been introduced, which has definitely caused American stocks to rise significantly in value. And I just don't believe that. I'm being cautious with that. I feel like I want to stay invested. I don't want to time the market too much. I once did that and it didn't turn out well. So learn from your mistakes and also look at yourself to see what you're good at and what you're not. I've learned from that. I'm not going to time the market, but I do want to have my money positioned in just good, strong companies with solid, reliable management and good plans and potential for the future, but not at too high a price. So I still have a few stocks like a Ploving with almost $20,000 profit. Has risen a lot in valuation, and it could very well be that it will drop soon, but it's about finding the right moment to sell, and I'll share that in my portfolio review shortly. In a moment, I'll show you what my transactions were from last month to position myself for 2025. But first, something about Argentina. Argentina, I think, yes. Somewhere at the beginning of 2024, I made a video about, listen, Argentine stocks can be very interesting. One example of that is Pampa Energia, but you can also see Centro Puerto, Banco Marco, Cresud Sociedad here on the screen. Yes, I sold some of them with a nice profit. And Pampa Energia was sold here with a nice profit. And unfortunately, I sold too early. So you see, if you have a good idea, you really should hold on to it. We mentioned Pampa Energia on the Happy Investor, or back in 2022. It has simply risen by more than 2,000%. Others did a bit less well. And of course, there are also some losers in there. If you want access to this, check out our Happy Value stocks, but also take a look at our growth stocks and dividend stocks. And we offer that for just, 30 cents a day. So that's not a lot at all. And it can be quite interesting. Of course, we have several in-depth analyses and we publish a maximum of one per week, per month. Actually, that might be a bit too much already, but we're trying to keep a balance between frequency and quality. Now, we're looking at the transactions, by the way. The total portfolios haven't changed much compared to the last update, which I think was in November or early December. December was indeed a bad dip, but that's also because Americans and others are selling stocks due to taxes. And now, fortunately, it has recently gone up again, and I've mainly bought more stocks. And as I said, especially European stocks, because I simply believe in them a bit more at the moment. Now, Booking Holdings has been sold recently. However, this is because a limit order was triggered. So I want to sell half of my own Booking share because I have two, if it drops below a certain level. Also because of the higher valuation at the moment. The price earnings was 35. At the moment of the drop, I still find it a bit on the high side. I still believe in the Booking, but the limit order has been triggered, and that's just how it is. I can't reverse it anymore, and I'm not going to. So that also has its advantages with the limit order. They always say, yes, don't sell the highest quality companies, but I do find valuation really important, and this is my choice. So I choose to reduce my position in one quality company and rebalance into another quality company, namely Evolution. Evolution has recently dropped a lot, and I had set a limit order here as well, but to buy Evolution has dropped based on news because this is a gaming gambling company, It's actually a kind of platform for casinos with software and real-time gambling entertainment that they create. I've shared about Evolution before, only based on the news that the UK has started an investigation into Evolution because certain casinos or online parties have used Evolution software without having the proper license. Well, that's a serious issue. That's an ethical aspect, so investors are banned. However, Evolution was already in a downward trend, and I had taken my first position somewhere around the summer of 2024. Well, that wasn't the best move, but I've been buying a bit more all the time. By the way, you never really know when the real market dip is. You don't really know when the bottom is. Technical analysis can help with that, but I really use it as a very last indication of whether or not to buy. But in this case, Evolution is still an interesting setup. Why? If we put it on candles, you can see that here you see a very small line, which means that this was the lowest price in that week. And in that same week, it rose to a price of 850, but it had actually dropped to around 800 in that specific week. Now that level happens to be at the same dip level as in 2022 and at the level of 2020. So here, have what they call technical analysts who say, yes, this is a strong support level, and that's where buying happened. Again, I'm not a technical trader or anything like that. I just look at valuations, and as far as I'm concerned, Evolution is literally just cheap. Even though it has risks like regulation, I think it's cheap. And if you also incorporate the game of technical analysis into your long-term strategy as a long-term investor, then in my opinion, I have a more complete view of when I can or cannot enter. So what was it then? I set a limit buy order, and that was at a price level of, I believe, 72. Well, then it actually dropped a little further. Then we decided to buy again. So one has kind of balanced the other out. What I've sold are actually the more risky stocks. Upstart Holdings, I've had that in my position for a long time, by the way. It performed poorly, but I've now sold it. It's not that I don't believe in the company. I just simply want to reduce my risk a bit. I sold Scorpio Tankers and bought in Extra Frontline. That's a shipping company. This is a commodity company, nothing special about it. However, there is a certain thesis that I believe in, and if you further investigate the company and look into that thesis, it could be very interesting for long-term investments. What I also bought more of is Nesty. Nest is performing really poorly, really frustrating, but I also explained that in the analysis. I find the company itself interesting enough for me to invest in for the long term, so I'm not worried. In the meantime, receiving high dividends around 9%. So yeah, it could be worse. I sold half of my Shopify shares, but not because I don't believe in Shopify. It's the same story as with Booking or for example, ServiceNow or CRM, which I also have. CRM refers to Salesforce. I've sold all of it purely because of the higher valuation. And with Shopify, I think the valuation has gone up again. So I'm patiently waiting for it to drop again, and then I'll buy in again. I keep repeating this little mantra, and so far it's working out well. But I still have half of my shares left, so it's not total market timing here. I bought more of Teleperformance. I'll explain that in more detail sometime. On the other hand, I'm not even sure if that's a good or bad move, Teleperformance, but the valuation is low and it seems like there's no belief in the company at all. I personally find that they have made two very interesting acquisitions. The management seems solid, but yeah, it's not a superior company. It's a call center, but on a global scale. I actually think that AI presents a big opportunity for this company, but the market sees it differently. The price varies a bit around 80 as the lower limit, so I bought a little extra. Sold is a bad company, or at least a bad company, but also a type that has made some interesting acquisitions. It's just that it doesn't come through. It's better worth of Mexico. Here, I feel like, yeah, because of that Trump story, I'm just going to sell this one. It wasn't a high quality company, so I like to take a bit more risk sometimes with small cap companies because they can potentially deliver high returns, but that doesn't always work out well. Finally, sold ETFs. I sold that rare earth metal ETF, but I did that purely because I wanted to buy more of the Chinese internet companies. And as the last transaction of the past month, Technion is a very interesting small company. They call it a serial acquirer. And we mention this term more often. Actually, those are kind of private equity companies, but then buy and hold. So just like Berkshire Hathaway, that's actually the biggest example. But you also have Constellation Software or Topicus, also another well-known example. And why Technion? Technion is just a small company whose management I really believe in. I find them honest and sincere. They also have a very interesting board. Just take a look at it and you'll know what I mean. Technian's strategy is to acquire niche technology companies. And yes, as a bit of risk diversification in the industry and technology, it nicely complements my portfolio. Then a brief overview of a few stocks to mention further. ACM Research, what is doing poorly, well, also because of the story with Trump. Rules set for import and export, and that's not working out well for ACM Research. I did buy a little more. Even though it's not a spectacular company, it does have a chance of succeeding. Advice Lab is very volatile, also a small serial acquirer. Alphen is finally starting to come back a bit from its dip. Alphen is a risky reset, but I'm Dutch myself. I know the company, I know my own company pretty well, and I feel like this company is undervalued, but the only downside is that the whole market is in a downward cycle. If you look up Monish Pabrai, a very well-known investor, he indicates that he buys distressed businesses in distressed times, meaning when there's just a good company that's having a rough patch, and also when the market is doing poorly, then he buys. And I think Alpha is just an example of that. Still interesting for further research. Aploving continues to perform well, it's incredible, but I have set an automatic limit order for Aploving to sell at a certain lower threshold where you just want to cash in on a part of the profit. It has risen a lot. So Aploving is an example of one of the good stocks that we have published within Happy Investors and Business Investors, a monthly update on our stocks. And that one is doing well. There are also some that are not doing well. Here you have Zeta, for example. I really bought Zeta at the wrong time. A short report came out. That short report made no sense at all, but that's how this strange world of investing works, where short-term traders, well, I don't have much good to say about them, but it happens. I bought a little more of Zeta, but unfortunately the timing was off. That can happen. You can never know that in advance, such things. So I just keep holding on cheerfully. Now the biggest position besides Aploving is Evolution. And although Aploving is performing very well and has become my largest position because of the returns, Evolution is not. But because I recently bought a lot more, and today apparently is also a good day with a 3.5% increase, and as I just showed in my transaction orders, I bought extra on that last dip. I'm only down 8% now. So that's the advantage of continuously buying more. So if you buy a stock that you think is undervalued, it actually gives you the chance to keep a little cash on hand in case it drops further, because you never know exactly when there's a bottom. You have the long-term game, the long-term investors, and you have the short-term game. And the market and a lot of asset managers and other entities that invest mainly in the short term. So as a long-term investor, you can benefit from that. But in the short term, it can also happen that a stock simply continues to drop. So yeah, you never have that under control. What you do have control over is your buying strategy. Evolution, as you can see, I've bought more. And by the way, it's currently paying out about a 3.5% dividend. I would prefer if they set the dividend policy to 0% and continuously reinvest in the business, but it is what it is. Other stocks, by the way, about Evolution, just to show what I mean by possibly undervalued. Here you see the price correlated adjusted operating earnings. In other videos, I explain how this works. Below you can see the EPS estimates. These are EPS estimates. Analysts, EPS stands for earnings per share. That needs to go up. Then it's suitable for growth. But you also need to buy at a good price. Well, for a long time, Evolution was very expensive. However, recently the price to earnings, or the PE ratio, is only at 14. That's relatively low, but more interesting. Because here, during the decline of 2022, the price to earnings was 20, and in 2020, the price to earnings was 50. Now it's significantly lower at 14. So basically, in 2 years, you're paying for a stronger company. It has grown more in that time at a lower price. And of course, also because a part of future growth and profit might be gone, but that's possible. I think it's not too bad, and that they can just keep growing. Look at the operating cash flow, then you see an even better picture. So in 2022, the one last dip, the price to cash flow was around 22.20, and now it's only 12. Well, I think the price to cash flow of 12 for a high quality company like Evolution is low. Yes, there is a big risk, which is the government that might intervene because it's an online gambling company, to put it simply. And of course, the government can intervene, but if they don't, then you have a very profitable company that just keeps growing. So that's basically the situation here. Also, if you look at EBITDA, the current EBITDA, the price of EBITDA around 10, 11, I personally don't think that's a lot for Evolution, but be careful, or I've invested a lot of money in it, but that's a personal choice. This is a risky choice. I hope it turns out well, But you'll probably see that in a year from now, I'll make a similar update and Evolution will be down 50%. I'm not surprised. It's happened to me before. So I don't see it as personal advice. As a tip, I can tell you I find Evolution interesting, but maybe start with 2 or 3% if you're a beginner company. And as a beginner investor, it's better to diversify a lot more and avoid mistakes than to take risks. Because why would you take risks? I just enjoy it as a game. For me, it's just a game and nothing more than that. Hims and Hers, there hasn't been much talk about it as an update, but I just find Hims and Hers super interesting. One thing is that I've actually owned the company since 2022. Yes, 2022. And I just took my profit out. So you can see here that the total profit is $4,600 and I have around $5,000 in shares. If Hims and Hers drops to zero right now, I would still have a small loss. So I've achieved a total return of less than 100% on Hims and Hers. You can see that here too. And then I sold half. And not because I don't believe in the company, but simply, yes, the market value is still very small for Hims and Hers. And the growth potential is still very large. So this position of 5,000, yeah, maybe if I'm lucky in the long run, it will go 10 times. I don't see any reason to sell. I'm happy to have Hims and Hers in my portfolio. So I'm just going to hold on to that. And yes, the valuation might seem high, but this is a really good example of a solid company. Well, I recently bought Instalco too. I gave an update about that back then. I mentioned that I also bought a little more of Technion, but it's down 11%. So I keep buying a little more. Technion isn't doing well either, but actually that's the story for a lot of European stocks. And that's what I've indicated. Starting from the summer of 2024, I'm going to buy more and more European stocks because of the valuations in America. But you also see me that Technion and a lot of European stocks have just dropped a lot, and those valuations have now become interesting. So I started somewhere, I don't remember exactly when, but I just keep buying a little bit more each time. And it also seems here that a possible bottom has been reached again, if you believe in a bit of technical analysis. I don't do that, but I find Technion interesting enough. It's just very difficult to make a good valuation of serial acquirers. For me, this is really a long-term hold, maybe a bit risky. The market value is around 300 million, maybe a bit more or less. If it multiplies by 10, then you have 3 billion. If it grows to 30 billion in the very long term, then you have a 100-fold increase. So yeah, then 7,000 wouldn't be 70,000, but 700,000. So one share could make me financially free. All I have to do is absolutely nothing. Waiting, a lot of waiting. And there are some stocks that I sometimes sell in a shorter time frame, but I just enjoy finding smaller, small cap growth stocks. But Technion is one of my long-term holdings. Zeta is another example. It can keep dropping a lot. It's down 30%, so yeah, it can still get worse than that. Another example is actually Stomco and Parsecuro. Super frustrating. I thought I bought this at a good price, and then it just drops by 50%. I've bought just a tiny bit here and there. Recently, it was around 6.3 for Parsecuro, but it just keeps dropping. So basically, the summary for Parsecuro and Stomco from my side is, what the fuck? The company's just good. Stomco recently bought a lot of shares from Extra. Of course, there's competition, and maybe I should have invested my money in Nubank. That's the biggest competitor of Parseguro. I just think that Parseguro and Stonico, because they are still so small, have a lot of growth potential. And actually, the only thing that's really holding me back is the inflation and the economy in Brazil. But I think that's a temporary phenomenon. And yeah, I'm not going to cut my losers here. It might be a mistake. Maybe in 3 years I'll make a video and I'll still be down 50%. Time will tell. I wouldn't recommend it to everyone. It's just risky. And I would trust TechMillion a lot more than, for example, Parsecuro. Finally, the last thing I haven't talked much about is Teleperformance. I just need to find out where it is. Oh, I forgot about that. Here is Despegar. Despegar is an example of a happy growth stock that we've also produced. Well, I bought some myself. A nice profit of 60% realized in 8 months. So that's good. That's certainly not bad. Only Despegar is overbought. At least it's under a bid from Proces, a Dutch investment fund. So they see it well. And I'm curious if sale is going to happen, or maybe has already happened. So I might actually have to say goodbye to Despegar, but we'll see. And finally, the last one is Teleperformance. I think Teleperformance is a stock, a company that you want to research further yourself. Today, European stocks apparently have a good day. In terms of performance, I've also bought in a bit more often because I started with a purchase price of I think around 92, and now my average purchase price is 86. As I mentioned, as previously stated, the cost level keeps fluctuating. It is important to note that with a lower limit around 80, we can see that here, so the lowest price level is around 80, 81 on a weekly basis, I would say. This stock has dropped a lot, as you can see, since that peak, but it was heavily overvalued here. It's down 77%, so it's the same price level as in 2016. I want to make sure they made a very large acquisition of Major L around this price in 2023. I don't know exactly how you pronounce it, but it's also a French call center with positions worldwide. So that's really a huge acquisition in terms of market value. And recently they also made an acquisition of a more interesting, smaller technology company that's in the same sector. So once again, a second strategic purchase. So I actually find Teleperformance fits within my strategy, namely the strategy of increasingly taking over serial acquirers. So these are basically just companies that keep making strategic acquisitions. And because of that, even if they don't achieve organic growth with their business, they can still realize high return on equity and return on invested capital by making strategic acquisitions, partly with a bit of debt. So that's riskier because debt can also have negative outcomes. And by doing that, they achieve return on return and also realize cost savings and synergies through good operational execution. Well, a lot of terms in one. Simply put, they acquire other companies that align well with their business. And as a result, the company as a whole can grow larger and potentially operate more efficiently. Teleperformance, just look it up. Possibly interesting as an investment, and I still find it worth it. I wouldn't say for the very long term. I would actually label it more as a kind of value/dividend stock, but more of a value investment. And if I'm wrong and missed a, well, then that's just how it is. The position is 9,000, which is about 5% of this portfolio, so that's definitely not on the low side. And I can only say that time will tell what this company will do, and of course I hope for good developments. I think it's undervalued. Finally, a very small update about my ETF portfolio. Actually, the most important update I want to give is that I've decided to adjust my strategy. I had quite a tendency to buy some thematic ETFs, but that didn't really turn out well. Well, the semiconductor ETF has performed really well. A lot of returns in a short time. I also had a cloud computing ETF. A lot of returns in the past 3 years, but I sold this one because of the valuations. And I also realized a lot of returns thanks to the Invesco QQQ, the technology ETF. However, I also sold this one because of the high valuation, and in return I reinvested part of it in stocks, European ones as you can see, but also in the Crane Shares China Internet ETF, which I've had for a while. I thought I had bought it at a low point somewhere in 2022, but it dropped even further, and every now and then I buy a little more, which has lowered my average purchase price. I'm down about 7%, but I don't think that says much, 7%. So I think the China Internet ETF has a reasonable chance of success because they are just Chinese companies. These are really good companies that are in this ETF. Tencent, Baidu, and some other larger powerhouses, GD.com, which could possibly be an interesting individual stock to buy. But I don't have enough knowledge about China myself. I just think that the current situation where China is struggling with such a large power and such a population, but especially the work culture they have there, gives them a competitive advantage, not in relation to America, but maybe in relation to other countries or geographies like Europe. So yeah, I do have confidence in keeping some money in there. And actually the global clean energy, that's just a hold for me, but that's also a bit personal. I just think sustainability is good, but not at any cost. I have a small position that I've had for a while, but I sold a lot of it for profit, even though it dropped a lot. I think that decline will last for a long time, just that the whole cycle is struggling. But my strategy for the coming years is actually to buy more when the QQQ drops significantly. And when I say a significant drop, I'm talking about a decline of 15% to 20%. If I'm lucky, it drops even more, and I keep buying continuously during those declines. Yet, over the past 10 years, I think I have to come to the very honest and realistic conclusion that it's particularly difficult to beat the Invesco QQQ. What do I mean by that? To achieve higher returns than that ETF. That's really by far the best ETF there is. It definitely has its downsides, but if you look at the companies that are in it with those super lucrative business models, I think the only criticism you can give is that those companies, like Alphabet, like Google, actually have very little book value, and that disruptive innovation can quickly destroy these kinds of companies, or while they can quickly destroy it, and that's true. The Invesco QQQ is just a basket of 100 of these amazing companies. You're of course trying to select individual stocks, like an Apple loving. I'm trying to do that in my portfolio. I'm trying to select relatively smaller, lesser known companies that can achieve exponential growth, but that also comes with higher risk. For example, look at Advice Lab Solutions, or right here. It's still just at minus 26%. It's already starting to rise significantly, by the way, but minus 60%, yeah, not everyone can handle that. And he was, I think 3 weeks ago, he was even at minus 35%. I keep buying, but a lot of people can't handle this, so why make it difficult and not just invest in the Invesco QQQ and achieve a high return? You also understand very well that all those asset managers and banks are ripping you off right in front of you. There are funds that achieve a decent return, true. However, they charge fees of about 2%, and I even know one that charges 2.9% per year in fees. Really ridiculous. Why? If you were to compare their performance over exactly the same time period with the Invesco QQQ or even the S&P 500, they don't perform better. Sometimes they even perform worse, but they still charge 2% or more in fees. I can't stand it. I can't figure out why people do it this way. Expensive words are used. Those suits, those expensive suits, you as a customer pay for them. Believe me, you're really being ripped off. There are very few funds that consistently perform better in the long term. And then you actually get people like Warren Buffett. Well, there are very few of those kinds of people. And if you also look at the fund structures, those are completely different structures. The standard funds charge 2% in fees, some maybe a little less. But those funds that really perform much better, the true value investors of the world, there are very few of them. Yes, those fund structures are actually based on the rule of 0.425 or 0.625. That means that 0% fees are charged up to a return of 6%, and there's also a high watermark, and only if they really achieve exceptionally high returns, then they get 1/4 of that. If a client doesn't win, I don't win either. Well, that might sound a bit technical. I'll explain that in another video. I've also gone on about it for too long, but just watch, I win. You have to invest yourself, and every investor can easily invest with confidence in an ETF portfolio that has a lot of risk diversification. For example, you can complement that with real estate funds. Take a look at some interesting links in our YouTube description. They are affiliate links, but check them out. You can download the brochures and gather information, and this way you can diversify ETFs with stocks, for example, with real estate funds, and you have quite a few other options like crowdfunding, P2P lending. If you do that, you might have too much diversification, but too much diversification at least gives a positive return, and all at lower cost than those expensive asset managers. So that's what I actually want to share. Thanks for watching. I would appreciate it if you subscribed. That supports us too. Give a like to the video if you find this valuable, if it has helped you, and also respond if you have any questions. I like to think along with you. Thank you, and see you next time.